Right, let's start off our first lecture on IAS 16, which covers property, plant and equipment. I like to do a nice summary, a standard on one page to give you a high-level overview, and then we'll delve into a bit more detail. So here I'm going to deal with initial recognition versus subsequent recognition for PPE. So initial recognition, well, the recognition criteria laid out in IAS 16 are exactly the same as the framework. First of all, the future economic benefits must be probable, and there must be a cost that can be measured reliably. Okay, that tells me when to recognize PPE, when those two criteria are met. Then, how much? Well, you'll measure it at cost. Now, cost is going to have some implications, so it's not as easy as it seems, but take note, it's initially recognized at cost. Remember to include things like a dismantling, removal, or restoration provision. We're going to go credit those provisions, debit PPE. Again, we'll deal with this in a bit more detail. Then note that spare parts or standby and servicing equipment will only be recognized as PPE when the definition of PPE is met. Okay. Otherwise, it's going to be inventory. We'll deal with that a little later on, but that leads us into day-to-day servicing costs. Remember, those are not property, plant and equipment. They must be expensed in profit or loss. Then, in subsequent measurement, you have an accounting policy choice. And that accounting policy choice is to measure PPE subsequent to initial recognition, either on the cost model or the revaluation model. Not the fair value model, the revaluation model. Let's look first at cost. Cost, well, obviously, you will never revalue, right? Remember that you will recognize initially a cost and then you will depreciate the property, plant and equipment on a systematic basis, i.e. straight line method, reducing balance, units of production, etc. You will take into account in that depreciable amount any residual value, and you must estimate the useful life of the asset. Last up, depreciation must be done using the component approach, i.e. within one asset you may have different parts, different identifiable components, like an aircraft. An aircraft will have the engine, the shell, the inner furniture and fittings. Okay, each of those will have different useful lives. You depreciate them accordingly and separately, but then you bring it all together as one asset, an aircraft. We also may have an impairment, but remember we only do impairment tests in terms of IAS 36 when there's an indicator of impairment for PPE. Okay, so that's the cost model, nice and easy. The revaluation model, here you will revalue, okay, to fair value, and the fair value or the revaluation gain goes to other comprehensive income. And thereafter you must depreciate the new revalued amount. The depreciation, please, ladies and gentlemen, goes through profit or loss, not through other comprehensive income. The reval gain went through OCI, and then you will depreciate this revalued amount, but through P&L. Last up, impairments, once again assessed for indication of impairment at year end. Okay, so nice and easy. We'll now go into more detail on different aspects of the standard. Thank you.